So this last part is something that happens at the end of every accounting year, something called closing the books. And closing the books simply means that at the end of 1 year's period of time, the records that we have to keep separate year to year are the revenue accounts, the expense accounts, and the dividends account. These accounts can only be kept for a period of 1 year, and then they must close. That's the thing, that they must close, because the very next day represents a new accounting year, and we have to keep that year's records separate from the records that we just did. And we do that year to year to year to year. And so closing the books is just a relatively normal business function in accounting. Okay. We close the books on 1 year and open the books for a new year. But that means we have to basically start counting our revenues all over again. And that means we also have to keep track of our expenses all over again for a separate year. So in order to do that, they've got to start at zero. You have to start at zero. And that's basically what closing the books means, is we're simply taking the revenue account, the expense accounts, and the dividends account and bringing all of those to zero. Now, where does that money go? Well, it literally gets transferred, as you know, into one of the permanent accounts. Accounts that don't go through a closing period because they don't measure a period of time. Okay? The balance sheet accounts, assets, liabilities, stockholders' equity, anything on a balance sheet has a date on it. It's just the day, right? The income statement, which is revenue and expenses, and the retained earnings statement, net income minus dividends, is for a period of time. So that's why they have to close. They're temporary because they're only measuring a period of time, and then that has to stop. That doesn't apply to the balance sheet, which simply tells you what your assets are that day, what your liabilities are that day, what your stockholders' equity is that day. That's it. It doesn't measure a period of time, so it's not affected by this. So how do we close the books? The process of closing the books is a 4-step process that's actually very reasonable to learn. Okay. And again, when we say closing the books, all we really mean is we want all these accounts to have a zero balance in them at the end of this process. So for example, if you had a savings account with $100 in it, and I said, we have to make that a zero balance, all you would need to do is take $100 out. You'd have a zero balance, right? Well, in essence, the closing entries are very much like that. We look at what the balance is in the account, and then we close it out on the other side to make both sides equal. Once both sides equal, the balance is zero. The first step is to close revenue. Now, revenue accounts, as you know, have a credit balance. Service revenue will have a credit balance. Well, how do we get that balance to zero? Well, if the debit side of the account equaled the credit side of the account, it would have a zero balance. So we would go ahead and debit the revenue account and move the revenue temporarily to an account called income summary. Income summary is simply a temporary account that we use to help us close the books. That's it. That's all we're going to use. It's the only time we use it. It doesn't have any other use. So very first step, close revenue to income summary. We do that by debiting the revenue account, because if the debit side equals the credit side, the balance will be zero. What do we do with the credit? We move it to income summary temporarily. The second thing that we do is close the expense accounts. Now we're talking about each and every account has to be zero in terms of a balance. You know that debit accounts have a normal balance on the debit side, right? So what do? Well, each and every account will have to have an equal credit because once the debit side and the credit side equal, the balance is zero. What do we do with all those debits? We move them to income summary temporarily. Okay. So what's going to happen after the first two steps is now at the end of this, revenue accounts are zero and ready to start the new accounting cycle. The expense accounts are all zero and ready to start the new accounting cycle. So just in the first two steps, we've accomplished a lot. The third step is now we don't really need this income summary account anymore. But look what's sitting in income summary: the revenues and the expenses, all the revenue and all the expenses. But hang on a second, what else has all the revenue and all the expenses? The income statement does. So what's going to be left in the income summary account is simply the net income of the company, because what's in the net income account is all the revenue and all the expenses. So the profit of the company is the net income. What we do is we close out the income summary account simply by moving the net income to retained earnings. Okay, that's the third step. And the very last step is we move the balance of dividends to retained earnings. Now remember, dividends will have a debit side balance. So to get dividends to zero, both sides have to equal. So we credit the dividends account and that'll be equal. Where does the debit go? We put it into retained earnings. What's happening in retained earnings is the same as what's happening on the retained earnings statement. We are adding the net income and we are subtracting out the dividends. This is the process in this way. Let's take a look at what it looks like on the journal. This is the journal, and these are the 4 steps, and I'll explain them again. Step 1 is we close revenue to income summary. The revenue account, to close an account, simply means to get the balance to zero. There's already $10,600 sitting on the credit side of the revenue account. To get it to zero, the debit side's got to equal it. So we debit $10,600, in this case, to service revenue, move that credit to income summary. So income summary now has all the revenues. Okay. The second step is to close the expense accounts. Now remember, every single expense account needs to be zero, which means every single expense account will need to have an equal credit to match the debit that's already there. Once you have an equal credit in each, all these accounts are zero. The total expenses are going to be transferred temporarily to income summary. So look what's in income summary just after the first 2 steps. All the revenue is income summary, all the expenses are in income summary. Revenue, expenses, totals, just like the income statement. So the third step is now we don't need that income summary account anymore. What's going to be the difference between the revenue and expenses on the income statement, on the income summary account? The profit, the net income. That's the difference. That net income has to be moved to retained earnings. Crediting retained earnings is the same as adding the net income to retained earnings. The debit to income summary makes the balance zero. And the last thing they do to close is to balance out the dividends account. Dividends is sitting with the debit side balance. So you credit dividends to bring that account to zero. The debit gets moved over to retained earnings. On the debit side, that shrinks retained earnings, which is exactly what we do on the retained earnings statement. We add the net income, subtract out the dividends. That's exactly what it looks like in the journal. The last thing is a graphic overview of what we just went through. That's on page 177, and it's just, if you just looked at the ledger, this is what would happen, okay? If you just looked at the ledger, the very first thing you would notice is that service revenue would get a debit of 10,600. Now, service revenue has an equal side balance. Credit balance and debit balance are the same, so the account has a zero balance. Where did this credit go? It went to income summary temporarily. The second thing you saw was all the expense accounts needed to close. How do you close an expense account? Expense accounts have debit side balances normally, so you credit each account so they balance to zero. Notice each of these accounts, zero, because they have equal balances. So all the accounts are zeroed. Where do all these expenses go? Temporarily to income summary. Income summary has all your revenue and all your expenses in it. It should look like the income statement. What does the income statement tell us? What the profit is. Well, for that, we have to move it out of income summary because we don't need this anymore, and move that over to retained earnings. Retained earnings, stockholders' equity account, credit side balance, increases it. Credit goes here, increases retained earnings, adding net income, same thing. And the very last thing we do is we close dividends to retained earnings. Dividends is sitting with a $500 debit balance. Closing it means we need to equal the sides. $500 on the credit side will give us a zero balance here. That $500 debit gets moved over to retained earnings. That makes sense because dividends shrinks retained earnings. And so debiting retained earnings would shrink retained earnings. Perfect. The balance in retained earnings, 2360, is exactly like your retained earnings statement. This particular account, zero beginning balance, adding the net income, subtracting out the dividends, ending balance, it should look exactly like the retained earnings statement. Should look exactly like that. Okay. What happens after you do the closing entries? After you do the closing entries, all your revenue accounts will be zero, all your expense accounts will be zero, and your dividends accounts will be zero. In other words, all your temporary accounts will have a zero balance. And all that will have balances will be your assets, liabilities, and stockholders' equity accounts only. And so you can prove that by doing another trial balance called the post-closing trial balance, which I'm not going to force you to do, but it's something that we would do after the closing entries. Look at what you've done over the last two chapters, okay? From part 1 all the way to part 4 here. This was chapter 3. All the stuff we did in chapter 3 was right here, the first 4 steps. And then step 5 all the way to here is everything in chapter 4. And between chapter 3 and chapter 4, that is the accounting cycle. Your book has a summary of it on page 178. I'm not going to go through it again. I'm going to get to our do it exercise, but that's what's on the slide. Everything that you've done, amazing. So let's do the closing entry do it exercise, which is on page 179. So if you have your book with you, page 179 is where we're at. And this is a company, Hancock Company is given to us with certain select accounts from its adjusted trial balance. And the accounts are listed here. And they want us to prepare the closing entries. So the very first thing we do, we close revenue. The second thing we do, we close expenses. So first, revenue. Here's your service revenue account. It's $98,000. This is sitting in the service revenue account on the credit side. So closing it would mean debiting the service revenue account by $98,000 and moving that temporarily to income summary. And now your service revenue account is closed to zero, ready for the new year. Second thing, the expense accounts need to be closed. Well, we have rent expense, we have salaries expense, and we have supplies expense. Those are the 3 expense accounts. All of these balances are sitting on the debit side in each of those accounts. So each of these accounts need an equal credit. The total will go to income summary. So here we have a total of $80,000 of expenses, and each individual expense account is zeroed out with an appropriate credit. Okay. So look what's sitting in income summary. Income summary is going to look like your income statement. $98,000 of revenues, $80,000 of expenses. Gee, can someone tell me what the profit is? $18,000. The difference is going to be the net income. Guess what? That's your third entry. Close your income summary account. You don't need it anymore. So we take the profit of $18,000 out of income summary on the debit side, move it to retained earnings on the credit side. Crediting retained earnings with the net income is perfect sense. The last thing we do is close the dividends account. Here's our dividends account. In the dividends account, is on the debit side. So a credit would close it to zero, and that debit gets moved to retained earnings, which makes perfect sense because we would take away dividends from retained earnings. You might notice something. That's the fourth step. You might have noticed something. There's a couple of accounts you didn't use. Well, why? Because closing entries is only for temporary accounts. Accounts payable is a liability account. It's permanent. It's not part of the process. Another account here, accounts receivable. That's an asset account. We don't use it. It's permanent. It's not part of the closing process. Permanent accounts do not close. Only the temporary accounts do. Okay. And that, my friends, is chapter 4. Questions?